If the market share of precious metals and precious metals related investments merely returned to mean, demand for these assets would increase fourfold. And I believe that will occur within 5 calendar years of today. I think that the disfavor that gold and silver find themselves in is a rear view mirror disfavor. It doesn't take into account debt and deficits. It doesn't take into account the necessity to inflate, and it doesn't take into account the historic cheapness of these assets and their reduced market share relative to other asset classes. The silver market absolutely takes off. It moves much faster and much further, but it doesn't move until the middle of the market.
Throughout history, gold has consistently demonstrated its ability to withstand crises. When geopolitical tensions escalate or financial markets become turbulent, investors often seek refuge in gold as a safe haven. Since 1998, the price of gold has surged from $256 per ounce to $2,000 per ounce, marking an 8 to 8.5% compounded gain over 24 years. Renowned analyst Rick Rule, founder of Rule Invest Media, speculates that gold's movement in the next 5 years will be more pronounced than in the past 2 decades, presenting a historic opportunity for undervalued gold companies, including royalty and streaming companies, senior producers, intermediate producers, single asset producers, and high-quality developers. Presently, gold is witnessing its second consecutive weekly decline as unexpected increases in U.S. consumer prices prompt traders to reassess rate cut expectations. However, gold rebounded slightly following a decline in consumer spending. Thursday saw a rise in gold prices due to softer U.S. economic data, weakening the U.S. dollar and Treasury yields. Attention now turns to Federal Reserve officials for hints on interest rate cut timelines. Rick notes that precious metals are currently out of favor in the market, with their market share in the United States accounting for less than half of 1%. He suggests that a return to the mean market share of 2% would represent a fourfold increase, a shift he anticipates within the next 5 years. Conversely, the price of silver closed above the $22.25 level yesterday. It started today with a clear upward trend, aiming to establish a bullish wave on an intraday basis with an initial target of around $23. Rick observes that while the silver market tends to move faster and further than gold, significant movement typically occurs in the middle of a bull market when generalist money enters the market and recognizes silver's relative weakness compared to gold. We will present clips from interview Rick Rules with Mike Maloney. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
But since 1998, the gold price has moved from $256 an ounce to $2,000 an ounce, which is to say an 8 or 8.5% compounded gain for 24 years. When's gold going to move? Well, over the last 2 decades. My suspicion is that the moves become more pronounced in the next 5 years than they have been in the last 20 years. And if that's true, then the gold companies, from the highest quality, the royalty and streaming companies, through the senior producers, through the intermediate producers, through the single asset producers, through the high quality developers, are in historical terms insanely cheap. And I'm not suggesting that your listeners put 100% of their net worth in expensive penny dreadfuls. What I'm suggesting is that gold is so deeply out of favor that the market share of precious metals in the United States, the largest savings and investment market in the world, is less than 0.5%, which is to say less than 0.5% of savings and investment assets in the United States are denominated in precious metals. The 40-year mean market share of precious metals is 2%. If the market share of precious metals and precious metals related investments merely returned to mean, demand for these assets would increase fourfold. And I believe that will occur within 5 calendar years of today. Yeah. By the way, it's estimated by JP Morgan Chase, and it's only estimated because they didn't have data going back that far, that the market share of precious metals and precious metals related assets in 1981 exceeded 6% versus 0.5% today. That's speculative. You don't need to say that demand is going to increase 12-fold. Increasing fourfold is certainly enough to reward investors and speculators. I find most investors in the world can't spell gold, despite the fact that it's a four-letter word. Your listeners are probably more sophisticated with regards to that. But the truth is that I think that the disfavor that gold and silver find themselves in is a rear view mirror disfavor. It doesn't take into account debt and deficits. It doesn't take into account the necessity to inflate, and it doesn't take into account the historic cheapness of these assets and their reduced market share relative to other asset classes. I postulate that every precious metals bull market is led by gold because the fear buyer predominates. When the fear becomes extreme enough that you get price momentum, the greed buyer comes in. And ironically, the price move that is caused by the greed buyer reinforces the narrative around the fear buyer, and the fear buyer increases his or her purchases. My experience tells me, irrespective of the gold silver ratio, that silver doesn't move until the middle of a bull market, that the market needs to be led by gold. When the narrative becomes broad-based enough that the generalist money comes in the market and looks at the relative weakness of silver compared to gold, the silver market absolutely takes off. It moves much faster and much further, but it doesn't move until the middle of the market. That the most volatile asset class of all are those few relatively high quality silver companies, because there simply isn't enough market cap in that space to hold the generalist money when it comes into the market. If you'll permit me a couple of examples, in the 1970s,
When the U.S. borrows money, it must repay with interest, akin to any borrower. However, America's national debt currently stands at $34 trillion and is escalating. The U.S. may spend more on interest annually than national defense. Former Treasury Secretary Robert Rubin recently described the U.S. economy as in a terrible place. At the same time, Black Swan author Nassim Nicholas Taleb warned of a debt spiral, resembling a death spiral. Rick emphasizes grasping the true magnitude of our debt. It's not solely the $34 trillion nominal value of treasuries or the $27 trillion net of the Federal Reserve's balance sheet. Instead, it's crucial to factor in the estimated $120 trillion NPV of unfunded future liabilities, as calculated by the Congressional Budget Office. This broader perspective underscores the immense financial challenge ahead. While individuals may need to adjust their lifestyles due to these liabilities, governments possess alternative mechanisms, notably inflation, to mitigate the burden. Nonetheless, Rick advises against solely relying on conventional inflation metrics like the Consumer Price Index, CPI, as they may not accurately reflect actual increases in living costs. Looking ahead, Rick urges viewers to adopt a longer-term perspective. Considering that many will live for decades more, it's vital to account for the nation's total debt, exceeding $140 trillion when divided among the population. Such a viewpoint is critical for informed financial planning. Let's get back to the interview.
Most people, when they look at the deficit, they look at GDP versus the Fed deficit. They look at the $34 trillion represented by bonds. They don't look at the net present value, never mind the nominal value, the net present value of unfunded liabilities, promises that we've made to each other. Social Security, Medicare, Medicaid, military pensions, the Federal Pension Guarantee Board, the Superfund, Trust Fund, all monies that have been earmarked, but any proceeds that have been appropriated have already been spent and reinvested in 30-year treasuries. It's important to note that the real debt that we face isn't the 34 trillion nominal value of the treasuries or the 27 trillion net of the Fed's own balance sheet, but rather adding that to the $120 trillion Congressional Budget Office estimate of the net present value of unfunded future liabilities. It's very important, I think, that your listeners think about that. And I'm not suggesting that they run away in terror and say it's hopeless. If you quit before you start, for sure you're going to lose. You just need to take it into account. But the truth is, if you yourself were confronted with a systemic deficit and unserviceable liabilities, you would have to change the way that you live and invest. The Fed, well, let me rephrase that. The government, because ultimately they possess the guns, has a different alternative. They can fraudulently reduce the burden through inflation. And my suggestion is that while inflation as measured by the CPI is moderating, that the CPI isn't an adequate measure of inflation. Secondly, my suggestion to your viewers is that they're looking at the next year, and most of them are going to survive 20 or 30 years. So they need to be looking further out. And when they look further out, they need to look at a total debt that exceeds $140 trillion.
Gold is expected to maintain a slight gain at $2,005.57, indicating cautious market sentiment. Notably, gold is hovering slightly above its pivot point at $2,002.62, indicating a bullish inclination that may persist as long as it remains above this level. On the other hand, silver is expected to demonstrate resilience, with a potential 1.9% weekly uplift, suggesting a move towards diversified asset allocation. We would love your thoughts on Rick's predictions in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.